In Chapter 16, we are going to be reviewing Problem 1632A and Problem 1634A. So let's start with 1632A. We have American Rare Coins, ARC, was formed on January 1st, 2018, and there's some additional data for the year as follows. We need to answer the following questions. The first is, what is the purpose of the statement of cash flows? Well, the purpose of it is to help users do the following: predict future cash flows of the company, evaluate management decisions with regards to spending their money in the current year, and predict the ability of the company to pay their debts off and their dividends. In requirement 2, we are asked to create ARC's income statement for the year ended December 31st, 2018, use a single-step format with all revenues listed together and all expenses listed together. So we have to look into the information in the problem. First of all, in Part A, ARC issued no par common stock for $450,000. Early in January, ARC made the following cash payments. So we need to decide which of these items looking at all these items, would have affected the income statement accounts. So rent expense on the store building definitely affected the income statement. That is an expense. Later in the year, ARC purchased merchandise inventory on account for $239,000. Before year end, ARC paid $139,000 of this accounts payable. Well, that doesn't affect our income statement. However, during 2018, ARC sold 2,400 units of merchandise for $275 each. So that's definitely a revenue. So that's the beginning of our income statement, $660,000 of revenue. Now it does go on to say that before the end of the year, the company collected 85% of this amount. So we'll keep that in mind. The cost of goods sold for the year was $250,000. That's definitely an expense, and you could see it listed there. The store employs 3 people, and their combined annual payroll is $96,000, of which ARC still owes $3,000 at year end. Remember, the $96,000 is what is in the expense account. $3,000 of it is listed as a liability to show that they still owe that. The depreciation. Let's go to the next one. At year end, ARC paid income tax of $17,000 and they don't owe any, so they must subtract that. And then the final expense is in H. ARC uses straight line depreciation over 5 years. So the store fixtures, $53,000 divided by 5 years would give us depreciation expense. So that's where the various items come from. Once again, the sales are determined in Part D. The cost of goods sold was given in Part D. The salaries expense was given in Part E. Depreciation expense is determined on the information in Parts B, 1, $53,000, and H, 5 years. Rent expense was given in Part B, 3, and then income tax expense was given in Part F. So we add all the expenses up. We get total expenses of $393,600. Subtract that from our sales amount of $660,000. The company has $266,400 of net income. Okay. What I suggest to you is that you print this slide off or you keep track of it somewhere, because we're going to be using this income statement for Part 4 of the problem. In Part 3, they want us to create a balance sheet. So there's a lot of information we've got to figure out here and see what information is provided. First of all, in Part 1, it said the company issued no par common stock for $450,000. What I suggest is you just do the journal entries for all of these various items. So that means the company's cash T account increased $450,000 and the company's common stock T account increased $450,000 on the credit side. In January, they made the following cash payments. So they debited store equipment, $53,000, and they credited cash, $53,000. Inventory, they debited $340,000. They credited cash, $340,000 when they purchased that. And then they paid the rent expense, debiting rent expense and crediting the cash. So I'm making these T accounts as we go as well, so you can see all this happening, or you can experience it as well on your end. Later in the year, ARC purchased merchandise on account for $239,000. So they increased inventory by debiting it $239,000, but increased accounts payable $239,000 on the credit side. Before year end, ARC paid $139,000. So debit accounts payable $139,000, credit cash $139,000. During the year, they sold on account $660,000 in sales. So we would have debited accounts receivable $660,000, credited sales revenue $660,000. They tell us they collected 85% of it. So if you take $660,000 times 85%, that means they received the cash of $561,000. So you would debit cash $561,000 and credit accounts receivable $561,000. They tell us the cost of goods sold amount, which would have been a debit to cost of goods sold of $250,000 and a credit to the inventory of $250,000. Now I'm just going to take a pause here. Right in my inventory T account, I have $340,000 on the debit from part B2 plus $239,000 from part C, and I'm going to subtract $250,000 because you would have decreased inventory $250,000 when it was sold. And if you add those and subtract that one, you will have a balance of $329,000 in the inventory T account. The store employs 3 people. The salary expense is debited for $96,000. Salaries payable is credited for $3,000 of it. So that means the other $93,000 was credited to cash. That was the part of the salary expense that was paid out in cash. At the end of the year, ARC paid income tax of $17,000. They have no income tax payable liability account, so that means they decreased cash for all $17,000 and increased income tax expense. The company paid dividends. So they either debited the dividends account or retained earnings for $44,000 and credited cash for $44,000. And then the final information is about the store fixtures. So we've already dealt with the income and expense items on the income statement. So now I'm going to focus on the accounts that appear on our balance sheet. The cash T account, I'm going to add those 2 debits and subtract my credits. So $450 debit plus $561, $561 gives me $1,011. Well, $1,011,011 I guess it would be. Now I'm going to subtract all my credits. So I'm going to subtract the $53,000, the $340,000, the $20,000, the $139,000, the $93,000, the $17,000, and the $44,000. And that gives my cash T account a debit balance of $305,000. My accounts receivable has a debit of $660, but a credit of $561 because 85% of them are paid off. So it has a debit balance in it of $99,000. Inventory I already determined. The store fixtures only has one item in it, so that has a $53,000 debit balance. Salaries. I'm sorry, let me make sure what else I wanted to do there. Yep. Accounts payable has a credit balance in it of $100,000. Salaries payable has a credit balance in it of $3,000. Okay. Now my retained earnings balance needs to be updated for the net income. And there's one other account. The store fixtures needs to have accumulated depreciation in it, and that accumulated depreciation will be the same as the amount of depreciation expense because it's the first year of operation. So on the credit side, accumulated depreciation, $10,600. So let's start creating a balance sheet with this information. First of all, our current assets would be cash of $305. Accounts receivable would be the $99,000 debit balance. And merchandise inventory has a debit balance of $329, which, like I said, if you take all these transactions and create journal entries and post them right into the T accounts, you'll get these answers. Property, plant, and equipment. The store fixtures cost $53,000, but then we subtract any accumulated depreciation related to it of $10,600, giving us total property, plant, and equipment of $42,400. We add the current assets to the property, plant, and equipment. Total assets $775,400. On the liability side, two liabilities. The current liabilities are $100,000 in accounts payable. We already determined that balance. Salaries payable has a credit balance of $3,000. So the total liabilities are $103,000. Common stock has a balance of $450,000. Remember, in Part A, they sold common stock. Retained earnings, net income would increase retained earnings to $266,400 for the net income, but then dividends decreases it by the $44,000. So if you take $266,400 minus $44,000, that gives you your balance in retained earnings of $222,400. So the total stockholders' equity is $672,400. Add that to your total liabilities, and you get total liabilities and stockholders' equity of $775,400. Okay, so you can very easily convert these transactions into financial statements. Now, you would want to print a copy of this out or jot it down because we use these two financial statements plus the information given there to help us create our final step in Part 4, the statement of cash flows. So here is this company statement of cash flows using the indirect method. Remember, there's the direct method and the indirect method. The indirect method converts net income to net cash from operations. So it takes a number, net income, that has some cash, some non-cash items, and translates it back into cash. And that's all we're doing there. The rest of the cash flow is the same whether you use the indirect or the direct method. This is an official financial statement. This is the fourth of the three. We wait till the end of Accounting 112, though, to teach it to you. So we have to prepare it like we do a balance sheet or an income statement or statement of stockholders' equity. You must be perfect with it. So we start with American Rare Coins, statement of cash flows, year ended December 31st, 2018, because we are showing how the cash changed during the entire year. Remember, we break these up by activities within the company. Operating activities are our first major activity, then investing activities, and then financing activities. So let's take a look at how we create and prepare each major section. First, the operating activities. So what are we reporting in here? Cash flows from everyday operations. We're looking at things from customers giving us money, to selling, to paying our bills, normal operations. What's involved in here from our financial statements? The income statement, current assets, current liabilities. That's our focus. Those are the items we focus on when determining, under the indirect method, cash flow from operations. So let's take a look here. We always start the indirect method off with net income. We then add back adjustments to change net income to net cash. So what we're saying here is that if we reported on our income statement the cash method of accounting, how much cash did we get from operations? The number we get at the end of this section would be that amount. We don't report that amount for net income. We report under the accrual method. We report stuff as it occurs, not as we collect cash or pay cash. So what we're doing under this adjustment to reconcile is pulling out non-cash items. Stuff has nothing to do with cash. So the first thing is depreciation expense. We subtracted that to get to $266,400. That has no cash component at all. We add it back. If we're trying to convert net income to net cash flow, we should have never subtracted depreciation expense. Now what we do next is we look at our current assets and current liabilities and how they changed. So we're done with the income statement. Everything else on there, it isn't a non-cash item. Now let's look at our balance sheet. We ignore the cash account because that's what we're proving here. How do we get that $305,000 in it? So the first thing we do is we ask ourselves, accounts receivable, the current asset, did that increase or decrease? Well, it increased. It started at 0, and over the year it increased to $99,000. So what's that saying? Well, those of all the sales we recorded, people still owe us $99,000 of it. So $99,000 of the sales are not cash yet. So included in that $266,400 is all the sales. And they're being treated right now as if they were all collected in cash. No, 99,000 of them weren't. So we must subtract that 99,000. Inventory. Inventory increased from 0 to 329. Well, we purchase inventory. Well, that means if our inventory increased, we spent an extra $329,000 in cash that's not reflected right now in our net income. So decrease. So those are the only two current assets. We've accounted for their change and we've accounted for their effect on cash flow. Now let's go down to the current liabilities. Our current liabilities go from 0 to $100,000. So we owe $100,000 more in accounts payable. So that means we have a cash savings in accounts payable. So we increase cash. The salaries payable increase. Remember, we subtracted $99,000 to get to that $266,400. Well, $3,000 of it wasn't paid yet. Add it back. Okay, so what we're doing here is using the current assets and current liabilities to account for items that have not occurred yet as far as cash goes, that are treated as subtractions or increases for net income purposes. So when we add the $10,600, subtract the $99,000, subtract the $329, add the $100, and add the $3,000, overall there's a net decrease of $314,400. Subtract that from net income. So what that's saying is that difference at $48,000, that's how much cash we used beyond what we brought in to do our normal operations. So we spent more to operate our business than we brought in cash by $48,000. And that's how we convert net income to net cash flow for operations. Now the next area, cash flows from investing activities. In here we focus on cash spent or received on long-term assets. The only long-term assets this company has is store fixtures. They spent $53,000 in cash. And if you're sitting there going, well, why are you subtracting it? Because we're trying to determine the effect on cash flow from buying these store fixtures. Cash flow went down, so we spent money for investing activities by $53,000. The final area of the statement of cash flows is where we account for changes in cash due to stockholders' equity and long-term liabilities. This company has no long-term liabilities, so we don't have any worries there. But how did cash change due to stockholders' equity activity? Well, cash increased by $450,000 when they sold the stock, and it decreased by $44,000 directly for the dividends. And if you're saying, what about the net income? We've accounted for the net income up in the top. You don't have to do anything with it. So overall, financing activities provided us with $406,000 in cash. So we brought money in by financing the company by selling stock. We spent $53,000 on store fixtures, our investing activities, and we spent $48,000 more than we brought in our operating activities. So we net those three categories together. Subtract the 48, subtract the 53, add the 406. And that will tell us how cash changed during the year. So cash increased $305,000. Cash started with a zero balance. So we take 305 plus 0. The cash balance, as we can verify on our balance sheet, is $305,000. So that was a great exercise to open your mind up a little bit to the statement of cash flows, see how the balance sheet and income statement interact to create the statement of cash flows. So that is problem 1632A. So now we're going to do the same process, the indirect method, but with 1634A. Now in 1634A on page 885 and 886, they already have our balance sheet and income statement for 2 years created. So this company is already in existence. Let's take a look. Now, what they're asking us to do is the statement of cash flows. I broke this down into two major sections. The first being the operating section. Now, I don't want you to think you do two separate reports. It's just that I didn't want to show the whole statement in your face all at once. So with Rolling Mills, it tells us that Rolling Mills purchased land that it financed with long-term notes. There was no sales of land. They didn't retire any stock. There's no treasury stock transactions. The plant asset was disposed of for $0, and the cost and accumulated depreciation of the disposed asset was $13,410. The plant acquisition was for cash. So we needed some more information so that we can properly record information regarding these items in the statement of cash flow. The first area of Rolling Mills, Inc. statement of cash flow, year ended December 31st, is the operating activities area, so we label it as such. Cash flows from operating activities. Just like before, we start off the cash flows from operating activities with net income, $96,400. We then add or subtract non-cash items, or items that are accounted for in the investing area, which we have none of those, but we do have depreciation expense. If we're converting net income to net cash flow, we should add that back. It should have never been subtracted if we're truly trying to determine cash, because depreciation expense has no cash element in it. Okay? Now, let's go back over to our current asset section. So you always follow these procedures. Accounts receivable went from a balance at the end of 2017 of $25,400. It increased to $26,500. So that means people owe us $1,100 more on the sales from this year. So that means $1,100 of our sales have not been collected yet. We decrease. We decrease. Also, merchandise inventory. It went from a balance of $91,500 down to $79,800. So that means that was a cash savings. We expensed more, $11,700, okay, than we replaced. So our cash increases $11,700 due to this. So whenever you have a current asset increase, the effect on cash flow is a decrease, and vice versa. Whenever a current asset decreases, the effect on cash flow is an increase, because you're not spending as much on that current asset. Okay, so we're done with current assets. Let's go down to current liabilities. Accounts payable went from a balance of $30,400 up to $35,700. So the difference, $5,300, is an increase in cash flow. Okay, so of the expenses we have recorded, we have not paid on 5,300 of them. Increase cash flow. If we did, our accounts payable would have been lower than 30,400. Last year's balance. Accrued liabilities, though, decreased. At the beginning of the year, we owed $30,300 in accrued liabilities. By the end of the year, we only owed $28,700. So we paid off $1,600 of those. So when a current liability increases, the effect on cash flow is an increase. When a current liability decreases, the effect on cash flow is a decrease. So that's another way of remembering it. Current assets, it's an opposite effect on cash flow. Current liabilities, it's the same effect. You're looking at the increase or decrease from the beginning of the year to the end of the year. So we net those changes due to non-cash items. And we would need to add $28,700 to net income to convert it from accrual basis to cash basis. So what we're saying here is if we did everything cash on our income statement, our net income would have been $125,100. But because we use the accrual method, it's $96,400. But on the statement of cash flows, we're focused on cash. How much cash did we make on operating activities? $125,100. Now, the next part of our statement of cash flow deal with our investing activities and financing activities. Remember, investing activities is where we look at long-term assets. Changes in cash due to these items. First of all, the land increased from $14,000 to $35,100. Okay. And they tell us right down below, the company purchased $21,100 of land, not with cash though. So there's no effect on cash from this purchase. They purchased it with a note. We'll deal with that in a few minutes. We only want to know changes in long-term assets from cash transactions. A plant asset was disposed of for $0. The cost and the accumulated depreciation was $13,410. So here's where I suggest you make a T account, because right now it says our plant assets started at a balance of $114,650. Ended at a balance of $124,840. So that's a difference of $114,650 minus $124,840, $10,190. But that doesn't mean they bought $10,190 in assets. No, we need to know, did they get rid of anything? And they did. They disposed of a plant asset that had a cost of $13,410. So during the year, they credited plant assets $13,410. So if I take the 114,650 minus 13,410, I get a balance of 101,240. However, the true ending balance is 124,840. So we bought or added an asset for the difference between 124,840 and the 101,240. Come on. I'm doing this in my calculator just to prove I'm right in my numbers. $23,600. So we actually have to determine if there's any increase or decrease from the information they give us. They could have just came right out and said they bought a plant asset for $23,600, but they didn't. So we've got to figure that out using the parts of the puzzle we have. We know the beginning balance, we know the ending balance, and we know they decreased the account. So we need to know, what did they increase it for? $23,600. Since we have no other information here, the assumption is they used cash. So the only item that affected investing activities was from acquiring a plant asset, and we're decreasing because we're showing the effects on cash from this purchase. The final area of our statement of cash flow is cash flows from financing activities. Remember, we're looking at changes in long-term liabilities and stockholders' equity here. So our first major item we're going to look at is cash receipt from common stock. So our common stock account went from $64,500 to $88,900. So it increased $24,400. The only time this account will decrease is if they retire stock. And it says right in there, no retirements of stock have occurred. So the difference was additional cash brought in from the sale of common stock. So this increase in common stock also has an effect of increasing cash. The other item on here is for retained earnings. Well, let's go to notes payable next, because that's what they do next. Notes payable went from 108 to 79,000. Started with a balance of 108. Now you got to be careful. Here's where the puzzle gets tricky. Notes payable went from a balance of 108 on the credit side to a balance of 79. And if you're looking here going, oh, it decreased. We paid that much. Okay, done. No. What happened during the year? The company purchased land with a long-term note payable. So during the year, they actually increased the notes payable by $21,100. So it starts at a balance of $108,000. They added $21,100. Those two together is $129,100. They ended up with a balance then of $79,000. So subtract that, and that'll tell you how much notes payable decreased, $50,100. So that means $50,100 of cash was paid on the notes payable. And you'll know if you did something wrong because your cash change won't jive out, and you'll see that. Now the final area is on dividends. They don't give us any information about dividends. We got to figure it out. So the first question is did the company pay any dividends? Well, let's see. How could we figure that out? Well, remember, retained earnings is where we account for dividends. Retained earnings starts with a balance of $10,100 at the beginning of the year. We know that it increased $96,400 because of net income during the year. But its ending balance is $41,900. So if you take the $10,100 plus $96,400, that gives you a balance of $106,500. Now our ending balance is $41,900. So that means it decreased the retained earnings $64,600, which without any other information, the assumption is the decrease to retained earnings was due to dividend payment. So we decrease The financing activities cash flow $64,600 due to dividend payment. So in this scenario, you've got to look at information and look at the puzzle around it to determine the true cash flow from financing and investing activities. The first part is pretty simple. You're just looking at the change compared to this, looking at the change from last year to this year and accounting for it. But you have to remember, when it comes to long-term assets, long-term liabilities, and stockholders' equity, there could be a few things in the account that affects cash flow. So we have to put it together like a puzzle. Now, overall, we take the cash of $24,400 from the issuance of common stock. We subtract the payments for notes payable and the payment of dividends. So we used cash for financing because financing activities caused cash to decrease $90,300. So if we take the cash from operating activities from the previous slide, which I didn't write down and don't have in front of me, but we'll see it in a second, we subtract the cash flow used for investing, and that we subtract the cash flow used for financing. Cash changed during the year $11,200 overall. Now, how do we know if we're right? Well, what was cash at the beginning of 2018? Well, look on your balance sheet. It was at $15,700. If you add the change in cash of $1120 to the $15,700, it should equal the ending balance of cash, $26,900, and it does. So you've properly accounted for all the items that affected cash during the year in the different categories. The final area of the statement of cash flows is where we handle non-cash, material, non-cash investing and financing activities. These are activities that you purchase an asset with a liability or stockholders' equity. In this case, they purchase land with a long-term liability, notes payable. So although it doesn't affect cash flow directly up in the top, you still list it at the bottom to let decision makers know, hey, they bought an asset and increased a liability. No effect on cash, but it was effect on the financial area of $21,100. So there's the complete cash flow statement for Rolling Hills Inc. Again, they provided $125,100 from operating activities towards cash. So cash increased $125,100 during the year from the company doing their normal operations. It decreased $23,600 from buying long-term assets, and it decreased another $90,300 from doing their financing activities. They paid dividends, they paid on their notes payable, they sold some common stock. Take the $125,100 minus the $23,600 minus the $90,300, and it tells you how cash changed overall for the entire year, $11,200. Again, add that to your beginning balance, and you get your ending balance of cash on the balance sheet. After you report that, you will report material non-cash investing and financing activities. And that's your statement of cash flows. Now, how will what you learned in this problem help you evaluate an investment? Well, I will be able to evaluate an investment with this information because I can see cash receipts and cash payments for a specific period. It can help me predict future cash flow, evaluate how well the company management makes decisions, and predict the ability of the company to pay their debts and dividends. And that's the whole purpose of the statement of cash flows. So that concludes our review of those two problems. Any questions you may have, please post to the discussion.